Understanding Investments, a Few Minutes at a Time, by Daniel Dower, from Chapter 10, Information Signals, Issue number 46, Dividend Signals. The price-to-earnings ratio, or PE, is the most common single metric for valuing stock. It has its place, but is subject to substantial distortion, deliberate or not, through special charges, impairments, and other means. Robert Shiller helped bring popularity to Graham's suggestion that we look at 5 to 10 years of earnings history rather than the trailing 12 months. Even then, something important is lacking. If I could only choose one metric to rely upon, it would be the long-term dividend growth rate. Dividends, unlike earnings, cannot be manipulated by creative accounting. They are not subject to arbitrary rules or standards. There's no adding back of depreciation or non-recurring charges. They are immune from accounting shenanigans. They are either paid in cash or they aren't. Many companies treat their dividend with reverence, as they send a clear and strong signal of financial strength and confidence in the future. This in spite of academic insistence based on the Nobel Prize-winning MM theory that claims stock buybacks and dividends are equivalents. Prior to World War II, companies had a tendency to pay out a percentage of the annual earnings as dividends. After World War II, certain companies adopted a different strategy. Established, financially strong companies began raising dividends every year and only cutting them in dire circumstances. Many now have decades of consecutive, uninterrupted dividend increases. Companies that engage in this practice send dividend signals. Management raises the dividend to the minimum level of future expected earnings. They don't want to go higher because if and when they cut the dividend, the market takes it to be a sign that future earnings are in question. Many are now deemed dividend aristocrats, defined as companies who have raised their dividend each of the past 25 years. If Coke, whose dividend streak now exceeds 50 years, were to cut its dividend, it could very well put the CEO's job in jeopardy. When I look at dividends, the long-term rate of growth is more important than the current yield. Many utilities and similar companies pay high dividend yields, about 5%, but they have low growth rates, about 3%. Long-term growth companies like Coke pay a lower current rate, about 3%, but they have a higher growth rate, about 10%. In several years, the Coke dividend yield will outpace the lower growth dividend yield. When a company raises its dividend by 30%, it's a flashing green light that management is confident in the next several years. I perk up and pay special attention to these events.